Yeah, thank you for this time, my viewers. Welcome to my channel. Today, I'm going to discuss a new topic. The topic is about IFRS 9 and how did these affect the financial system, and we like to discuss how it affected a little bit of how it affected our banks in Kenya. So IFRS 9 means International Financing or Financial Reporting Standards, and this is well established or well published in our International Accounting Standards Board, the IASB. So when you think about IFRS 9 as an international way of setting the guidelines of accounting and financial instruments, it has several uh, items which you can think of, or items which you need to understand so that you are able to know what the IFRS 9 means. And because there are around 4 points, I'll try to mention them, but after that, I'll just discuss how one of the four key pillars of IFRS 9. IFRS 9, when it was implemented in Kenya, it affected the financial instruments such as loans, bonds, and other areas of the banking sector. So one of the key pillars which affected or which you need to know is it affected the classification and measurement of financial instruments, and it also touched on the impairment of financial assets, and it also affected the aging IFRS 9 and there's some disclosures on how you're supposed to disclose your assets as a financial institution or an organization. So classification and measurement of financial instruments. IFRS 9 introduced a criteria to classify and measurement of financial instruments. And these resulted to changes in the way the financial instruments are classified and measured in Kenya, which led to changes in the balance sheet or the income statement of the companies. So the second one is the impairment of financial assets. These also is being recognized as the impairment of losses based on the expected credit losses rather than the incurred losses. And these also resulted in the high impairment of charges for companies in Kenya, particularly those with high exposure to credit risk. And the third point is the aging of IFRS 9, which introduced a more principle-based approach to age accounting. These resulted in changes in the way companies in Kenya account for aging transactions, which led to changes in income statement and the balance sheet too. So the other fourth factor is about disclosures. The IFRS 9 also touch on how companies are supposed to disclose uh, about the nature and the extent of the financial instruments held by a particular company, as well as the risks and uncertainties associated with those instruments. This resulted also in a more expensive and detailed disclosures by the companies in Kenya. So to explain all that, in overall, the implementation of IFRS 9 in Kenya is likely to lead led to changes in financial reporting practices and made a significant impact on the financial statements of a particular company. So generally, this is touching on the balance sheet and the income statements on how they should be, or what should be captured in those statements. So I would like maybe to touch one point, and that is the impairment of financial assets. What you should be figuring out is when you get a loan in a bank or in any financial organization where you belong into. Once you get that facility, the facility is supposed to be reported. And how are the banks supposed to report that? That means that loans must be classified in a particular manner so that they are reported. And when a loan is well performing, or if you are paying your loan very well, that loan is classified as normal. So it doesn't have any risks involved in it. But as per the IFRS 9, remember they are supposed to report your loans depending on the expected losses. So if they expect that your loan is supposed to go into default, or you are unable to pay, or your loan is doesn't have enough security, means that in case you default even 1 month, that loan is at a risk because there is no security. So that we can say that that loan you are having has an expected loss even if it is well performing. So the question is, what should bank do in case that you have unsecured loans? And these unsecured loans can be check off. For example, if you're employed somewhere, you access a check off. Or if you have a loan which is unsecured, like the micro loans, mobile loans you are getting from banks using your mobile phone. Generally, those loans don't have security. So the expected loss is 100%. So that means they are supposed to provide those loans in that manner. So the other category is that loans as if your loan is not being paid from day 30 to 60 and you have not serviced your loan by paying your installment, that loan is placed under watch. And there's a percentage which the banks use to calculate the expected loss. And that those loans have 1%. 3%. For normal loans, they're supposed to give a 1% of expected loss. So if your loan is also with you have not paid your loan for a longer period, that is 60 days to 90 days, that loan is supposed to be classified as substandard. So it means that the risk is higher, and the bank should at least provide the risk by giving a provision of that facility, which is based on 20% of the total loan. So the other one is called doubtful or loss. These are loans which you have not paid for a period of 90 days and above. That means that loan should be provided 100%. So what happens if your loan is not secured? It means your loan will be provided 100% from the word go. And that's where now IFRS made a major impact to the financial organizations. So now they're supposed to report, because if they give their loans if they measure their loans on unsecured lending, it means that at any given moment their loans have an expected loss of 100%. So what happens if they are supposed to report their books as required by the law? Most likely they might report losses, because if they measure their loans on those facilities which are not secured, they provide 100%. So if, for example, if they have given loans up to 20 billion Kenya shillings and they are not secured, it means they provide 20 million, 100% of 20 million. So they'll report uh, a loss on their income statements, or the profit and loss account, or their balance sheet, to show that they gave a provision of 100% of the loans which they gave out because they are not secured. So it's very important nowadays for the banks to make sure that they give their facility to those customers who have at least a security to cushion themselves against any outcome in case their customers don't pay their loans on time. So that is a major thing you need to know about the impairment of financial assets when it comes to reporting their loans as a bank. So we have left with at least 3 points, which I'll also be mentioning them on my channel, and to be able to discuss further, to be able to understand what maybe the classification and measuring of financial instrument means, what aging means, and what about disclosures. What are they supposed to disclose when they are reporting under the IFRS 9, or the International Financial Reporting Threshold, which is a standard published under the IASB as per the required standard, or required organizations which give directions on how international financial institutions should do. So thank you very much for listening to me. You can subscribe to my channel, and also give a thumbs up if you have gotten something important to learn from today's discussion. Thank you very much, and have a lovely